A banking app opens to two balances at the top of the screen: checking and savings. A separate app shows a brokerage account below. The numbers are different. More importantly, the way they move is different. In a savings account, the balance changes only when money is deposited or withdrawn. If $5,000 sits in savings today, it will remain close to that number tomorrow. Interest may add a small amount at the end of the month. The movement is gradual. In an investment account, the balance changes even when no deposits occur. A portfolio valued at $25,000 may show $24,600 tomorrow, or $25,400. The fluctuation happens because the assets inside the account are priced by the market throughout the day. Savings accounts are designed to preserve principal. Investment accounts are designed to expose principal to return and risk. Open the transaction history of a savings account. Deposits appear. Withdrawals appear. Occasionally, a line labeled interest credit is added. The pattern is predictable. The line graph, if shown, moves in small upward steps. Open the dashboard of an investment account. Positions are listed with tickers and percentages. A chart shows daily price movement. Gains and losses are calculated automatically. The line graph rises and falls in visible waves. The difference between these accounts is structural. Savings holds cash or cash equivalents. Investing holds assets such as stocks, bonds, or funds that represent ownership or debt participation. Savings accounts are typically insured within certain limits. The deposit is protected under established frameworks. The trade-off is modest return. Investment accounts do not offer guaranteed principal in the same way. The value depends on the performance of underlying assets. Returns are uncertain in the short term. Consider time horizon. If funds are needed within the next few months for rent, tuition, or planned expenses, predictability matters. Savings provides that predictability. If funds are intended for use decades later, daily price movement becomes less important than long-term growth. Investing provides access to that growth. On a monthly bank statement, savings balances reflect transfers and interest. On a brokerage statement, investment balances reflect contributions and market performance. Inflation introduces another layer. A savings account earning a low interest rate may maintain nominal balance but lose purchasing power gradually if inflation exceeds that rate. Investments aim to outpace inflation over long periods. Historical market returns have often exceeded inflation, though not consistently year to year. Consider two balances of $10,000. One remains in a savings account earning 2% annually. The other is invested in a broad market index averaging 7% over long periods. After 1 year, the difference appears small. After 5 years, the gap widens modestly. After 20 years, the divergence becomes structural. The savings account grows steadily and predictably. The investment account fluctuates year to year, sometimes declining, but the long-term growth rate compounds differently. The visual gap on a 20-year chart reflects the difference between preservation and growth. Open a 10-year market chart. The line does not move evenly upward. There are declines, recoveries, periods of sideways movement. Over extended time frames, growth may become visible. Open a 10-year view of a savings account. The balance reflects only deposits and small interest increments. It does not respond to corporate earnings or economic expansion. Savings stores value in stable form. Investing allocates value into productive assets. A paycheck arrives in checking. A transfer moves a portion into savings to build reserves. Another transfer routes funds into an investment account for long-term allocation. The separation is deliberate. If all funds remain in savings indefinitely, the balance remains stable, but growth potential is limited. If all funds are invested without regard for timing needs, short-term withdrawals may coincide with market declines. Volatility is visible in an investment account. A portfolio may decline 5% in a week. The same decline does not occur in a savings account. Volatility reflects price discovery in markets. Savings reflects fixed deposits. Consider an unexpected expense. A car repair invoice arrives. Funds are transferred from savings to checking. The balance decreases by a known amount. The remaining savings remain stable. If emergency funds were held entirely in investments, a withdrawal might occur during a market downturn. Shares would be sold at prevailing prices. The timing would influence the realized value. When savings and investing are not separated, short-term needs and long-term capital compete for the same dollars. A market decline can turn into a forced sale. A lack of liquidity can interrupt compounding. The mismatch is not about preference. It is about timing. Funds intended for near-term stability behave differently than funds allocated for long-term participation. Now, consider retirement funds with a 25-year horizon. Short-term market declines appear significant in a quarterly statement. Over decades, the effect of consistent participation may dominate those temporary fluctuations. Savings is measured in months. Investing is measured in years. Interest credited to savings appears as a small recurring entry. The rate is visible and predictable. Market returns appear as daily valuation changes. The experience is variable. On a financial planning worksheet, savings targets are often defined as fixed amounts tied to expenses. Investment targets are often defined as future balances or income projections. The visual contrast reinforces the functional contrast. Savings graphs are relatively flat. Investment graphs are dynamic. Neither tool replaces the other. Without savings, short-term disruptions can force liquidation of long-term assets. Without investing, long-term capital may not grow beyond inflation. Open both apps side by side. Notice how one balance barely moves day to day while the other shifts visibly. The difference is not an error. It reflects purpose. Over months, savings may increase slowly through deposits and interest. Over the same months, investments may rise or fall depending on market conditions. Over decades, the cumulative effect of long-term investment participation can create divergence relative to cash balances. Savings protects against immediate uncertainty. Investing participates in economic growth. If markets decline for a year, an investment account may show a lower balance than the prior year. A savings account during that period may show a modest increase from deposits and interest. The question is not which balance looks calmer in the short term. The question is what role each balance is intended to serve. On a household balance sheet, both categories often appear. Cash equivalents on one side, market-based assets on the other. Transfers between them are recorded clearly. Money flows to savings for stability. Money flows to investments for growth. The pattern over time reveals allocation choices. On many household balance sheets, savings balances rise first. Investment accounts remain small for years. Over time, the proportion shifts. The investment account gradually becomes larger than cash reserves. The transition does not happen suddenly. It happens through recurring transfers and time passing. A year of consistent saving builds liquidity. A decade of consistent investing builds capital. The difference between saving and investing is visible every day in the movement of numbers on a screen. One balance changes slowly and predictably. The other moves with markets. One preserves nominal value with stability. The other exposes capital to fluctuation in pursuit of long-term growth. The distinction becomes clearer the longer the timeline extends. On a daily screen, savings appears calmer. On a multi-decade chart, investing often appears more powerful. Both operate inside the same financial system, each performing a distinct function over time.